Jim, let's talk the carnage on Wall Street we're seeing today. Is this really just the Fed downgrading the economy here, or is there something else?
This is the Fed basically telling you, listen, it's a little worse than we thought. Fed talking about global financial strains, coupled with the fact that there's a worldwide sell-off in what was the currency of the realm for emerging markets, which have been the beacon, the thing that's worked throughout this period, which is the coal sell-off, iron sell-off, copper sell-off, and oil sell-off, although not enough for oil, because that's the key commodity. We need to see oil come down big, and I'm not talking about West Texas, but Brent, which is what matters.
Right, you mentioned under 100, and that's when the story changes.
Under 100, and then I think you'll see liquidation. I think you'll see companies finally say, you know what, we got to start selling oil before it really goes down big. Lately, the psychology had been the opposite, which is as long as we withheld oil, we continue to make a lot of money. But I think that 100 will be a level where people say, wow, I better go lock it in, I better go sell the futures. And I also think you'll see a liquidation by hedge funds that have been using this as if it were a dollar or if it were stocks.
We're almost there, and we're just a couple bucks away. So
you got to see it happen, though. I mean, one of these things that has happened is that anytime you jump the trend line and predict that, that something is going to go through because it's a few dollars away, then it bounces. Brent is right now the key to the next 6 months.
So then what does an investor do looking at these markets, looking at oil not down enough? What do they stay on the side?
I think, no, you can't stay on the sidelines because the sidelines mean no return.
Right.
What you do is you say, okay, look, with the 30-year below 3, with the 10-year below 2, you look for bond equivalents, and a bond equivalent is a Bristol Myers, a bond equivalent is a J&J, downgraded today by Goldman, barely down.
Right.
You are being forced by Bernanke into equities. Was that his desire? I don't know. He understands that equities represent a tremendous form of wealth for people. He seems to be much more understanding of that than President Obama. I'm not criticizing Obama, I'm just saying that some people are more focused on the wealth effect, and Bernanke's uniquely focused on what he's trying to do, I believe, is make it so the consumer feels better, and he's trying to make it so the banks refinance. He can't make the latter. The regulators have to do that.
All right, so you mentioned BMY and Johnson & Johnson. What about gold? Because the chatter is all about we're going to see another $150 sell-off, et
When
cetera.
you see these metals go down severely, when you see copper go down like this, if oil breaks 100, you recognize that there are hedge funds like 2008 that have made very big bets, leverage bets on these. And we're not fighting a secular trend in gold. I think it's still terrific. You're fighting a liquidation trade in gold, meaning that you've got to let these weak hands go before you can buy it back. So that's my posture right now. If you haven't, I like gold very much, but if you haven't bought it, now wait. If you have a huge profit in it, you want to take off 10 to 15%, I'm not going to fight you.
You think we'll see more margin requirements for all these commodities?
No, it won't be margin requirements. It'll just be hedge funds kicking it out because they have to liquidate.
All right, thanks, Jim. For more on Jim's stock picks, you can go to cramerspicks.com.